Hi, good afternoon, everyone. My name's Stuart Singer. I'm one of the partners here at RBP Chartered Accountants. I'd like to thank you all for joining us on our first live webinar. There's a few more people joining, but we're up to 35 people at the moment, so we're very happy with that. The subject of today's webinar will be topical tax tips, and we aim to cover a number of issues, which include a nasty new HMRC initiative and the taxpayer who received an unexpected tax bill of £1.2 million on her doorstep last year. This webinar will be the start of a regular programme of webinars on a variety of subjects. If there's any topics that you would like us to cover, then please get in touch. During the course of the webinar, we'll welcome your questions and observations, and where possible, we'll reply to you. Feel free to tweet us using the hashtag RBP or on our Facebook page. RBP are the leading firm of chartered accountants in the UK in the medical sector. So that covers doctors, dentists and surgeons. However, in addition, we've recently launched a bespoke tax specialist bureau. We can advise businesses of all types. However, in particular, we specialise in the construction industry and the IT businesses. We also advise high net worth individuals who need help structuring their tax affairs in an efficient way. And in particular, we can assist you if you're non-domiciled and you live in the UK, or you're currently living in the UK but you're thinking of moving abroad. Today I'm joined by Tim Palmer, who's one of the specialist tax team here at RBP. Tim is one of the UK's best known tax presenters. He's been lecturing on tax and advising clients for over 30 years. Welcome, Tim.
Thank you very
joining
much.
us.
Thank you, Stuart. Yeah, I'm Tim Palmer. I've been lecturing on tax now for over 30 years. My wife always says to me, there's two things I know, tax and Tottenham Hotspur Football Club, but we won't talk about the latter subject. But being serious, tax is my thing. Since 19, really, I've been involved in tax full time. And I spend half the week now lecturing on tax all over the UK and sometimes abroad. And the other half now, I'm delighted to have joined RPB since the 1st of April. My role here for RBP is that I'm going to try and review their clients' tax affairs and look at our clients' positions, and wherever possible, I'd like to try and do tax planning to reduce their bills. There's a lot of opportunities out there, a lot of tax cases, and I want to see the clients really and help them minimise their tax bills.
Excellent. So Tim, tell me, as of today, what would you say is a couple of very key issues that taxpayers need to be worried about as far as HMRC are concerned?
Right, well, hottest issues, there's a few actually, and let me just mention some of them. The first one is that I would say probably about 3 or 4 months ago, maybe a bit longer, one of our clients started to receive a questionnaire, and the revenue sent this questionnaire. It was a 5-page questionnaire, and fairly shortly we got the impression that the revenue was short of staff and they were looking to replace pay-as-you-earn audits by this postal questionnaire. It's a 5-page questionnaire. A lot of clients have now received it. Yeah. It's a bit dangerous because in most cases it's sent to the client without us seeing a copy. And some clients have tried to complete it themselves and send it back, and there's been problems with that. I think any client who gets this pay-as-you-earn questionnaire should contact us, and we need to discuss it with you and complete it with our assistants. It's quite a lengthy document, and it does cover lots of different things like the number of consultants you use, your director's loan account. From what we've seen on the questionnaire, there's one particular area that HMRC are really going for on it, and that's mileage claims, mileage allowances, and you've got to back those up with all the documentation. So it's a very big document, and I think clients would need our advice on completing it.
It feels to me, when I've looked through it, that it almost feels the Inland Revenue are trying to drive you in a direction which is possibly not the direction that we want our clients to go in.
I'd agree with that. I think really careful consideration needs to be considered when completing that form with our assistance.
Okay. Any other areas before we
Yeah.
get into the main body of what we want to talk about?
There's a few actually. R35, this is the attack on the one-man band company, but we're going to come to that later. But I'll do one other thing that maybe our clients haven't heard about, and perhaps, you know, we hadn't previously discussed it. When clients have a dispute with HMRC, quite often you get to a stalemate, and you get to the position where you think, where am I going to go from here? Well, you could go to court, but that takes ages, it's very expensive. And what we've started to do with clients who have disputes with HMRC, there's something that we can do for you, and it's called alternative dispute resolution, but it's called, abbreviated to ADR for short. And with alternative dispute resolution, we would go online for the client and notify the revenue and say, we want this case that's being disputed dealt with by ADR, alternative dispute resolution. And when the accountant, when we do this, we apply online and the revenue consider it. In most cases, they allow you to have ADR, alternative dispute resolution. And then what happens, an independent mediator is appointed, and we would meet the mediator. You and I would go along with our client, and HMRC would be there. And the mediator mediates and tries to reach a middle ground and agree the position.
And presumably that is a much faster process.
Oh yeah,
than
a million times, and much cheaper.
Yeah.
I mean, very, very briefly, I've been involved with quite a few ADR cases. There was one on VAT where the VAT was quite a big disputed figure. The mediator I thought was excellent, and we got all of it agreed, and the VAT was the figure we wanted. We've done it on capital allowances, lots of things. So that's another route that we can recommend to clients.
Yeah, this is a very positive route as well.
Yeah, it is, and very quick and very cost effective.
Yeah, absolutely.
Yeah.
So just moving on to the first point that we really, the first pre-prepared point.
Yeah.
So as most people will know with us today, your home, i.e. your principal private residence, is where you live, and you can elect for one property to be your principal private residence if you have more than one. This has always been tax-free, and there's no dispute about that. There's no issue. However, there's been some changes on that recently that I think most people will not be aware of. Can you give us some more information on that?
Yeah. Well, this principal private residence relief claim is the biggest claim that a client has. I mean, the client, basically their one main asset is their home. And when they sell it, that they want the gain on it to be exempt from CGT. That's everybody's aim. But there's been two or three things that have affected PPR, and when a client sells their principal private residence, in the last year or so, things have been changing, and I'd say, Stuart, not for the better. Let me give you some examples. Let's do three. There was a case very recently called Topical, where a taxpayer who lived in Finchley in London.
A bit close to home, really.
Too close to home, actually, yeah. This client lived in Finchley. He bought this house in Finchley. It's quite sad, really, because he'd separated from his wife. He was going through the divorce process. It was all quite sad. And he bought this property very near Finchley Central Station, you know, the train station there. And it was his principal private residence. But he kept on running home to mum, so to speak. And she cooked him a lot of meals at her house. I think he lived there quite a lot. He did his laundry there. And then later, Mr. Topical sold his house, made a big gain. And like everyone does, they claimed the CGT exemption principal private residence relief. He didn't get it. And do you know why he didn't get it? The reason he didn't get it, because HMRC have now introduced, which I think is really unfair, this new claim, this new condition, if you like, called quality of residence. And they said that Mr. Topical's quality of residence while he was living there was not good enough to give him the PPR. And I'll tell you one thing, I have never mentioned this to you before. When I was lecturing last week, and I mentioned this case at a lecture, an accountant put his hand up and he said, we've got that case at the moment. similar case where a young individual buys a house, and when it's your first house, you would surely expect that you would go home to mum, wouldn't you?
Yeah,
if you were a bit younger, Stuart, no disrespect.
Don't like doing your own cooking.
Yeah, and you'd run home to mum. But I've never known this in all my career in tax. There's a new condition now called quality of residence, and if you don't meet it, as Yeichel didn't, he failed to get the PPR.
So quality of residence, is that saying that you're expected to be based there all the time and living there all the time?
Well, I think the position with that is that Mr. Yeichel, he didn't furnish the house fully. It was very sparsely furnished. There was no lounge furniture. There wasn't a table for him to eat meals.
Right.
And so I think the revenue were looking at other things, but they honed in on this, and they said, we don't really think that this house is your principal private residence. And they introduced something that in all my career in tax I've never seen before, called quality of residence. And all the tax magazines are going mad about this. Can I tell you a slightly amusing story about it for 2 seconds, if you've got 2 seconds? Obviously, I'm a mad Tottenham fan, but I love boxing, and I used to box quite competitively. So I watch boxing channels. And there was a boxer recently interviewed, a well-known boxer, before his fight. And he was giving this interview to the guy, asking him about his lifestyle away from the boxing ring. And he said, I'm a mummy's boy. Every couple of minutes I go home and my mum does everything for me. And my mind never switches off from tax. As I'm watching this at home with my wife and kids, I'm thinking, Mr. Yeichel and CGT position.
Yeah, absolutely. You've got to be very careful what you
say.
You do,
absolutely. Yeah.
Okay, so let's move on to the next point. That's definitely something to be very aware of. So what's another very hot topic at the moment is, yes, go on.
So sorry, but just one final thing, which I'm sorry to interrupt you, Stuart, but I think it's very important. On the subject of principal private residence relief, when you sell your home, there's one other angle that a lot of taxpayers are having problems with at the moment, and that's when they buy the house off plan. So if somebody is invited to purchase a house and it doesn't exist, which is happening more and more these days, if they exchange, because CGT, when you exchange, is your date of acquisition, and a lot of people are buying off-plan properties. You read the property journals, it's happening more and more. And the potential problem with that is that anyone buying off-plan now, when they exchange and put the deposit down, if there's a long gap between exchanging and when they completely move in, that gap is potentially a tax chargeable gap. And when they eventually sell that house, HMRC will go back, see that they bought off-plan, and from the gap between when they exchange, put the deposit down, to when it was built, when they could move in.
Could be 18 months.
Potentially, the revenue will apportion the gain over the ownership of the property, and the period that they didn't live in it when they exchanged to when they moved in is a chargeable period.
Particularly if they're living in their existing property during that time.
Yeah, well, that's another issue, but very dangerous. There's been a case on this, and if any of the viewers are really interested, they should Google this case called Higgins versus HMRC, which was last year, and Mr. Higgins did move in off plan. There was a long gap between when he exchanged and when he actually did move in. He lost the case. And the period between exchanging and when he moved in was charged to CGT. And, you know, I'm very involved in the property world, and you see more and more people now wanting to buy off plan. Very dangerous, potentially.
And the changes in the rules relating to the last period of ownership, that could be affected as well.
That is, there's so many things with PPR. Perhaps we'll make this the last issue on PPR, but you're very relevant what you've said. A few years ago, people used to buy houses, move into them, and they were comfortable knowing that the last 36 months, the last 3 years of ownership was always CGT free. Whatever you did, you could go abroad, you could rent it, whatever. A few years ago, that was reduced down to 18, halved. And from 6th of April 2020, it's now halved again to 9 months. So from next year, anyone selling their principal private residence, if they've got a job abroad and they have to leave, you're only going to get the last 9 months of ownership CGT free.
This is quite significant.
It is significant. And do you know why it's a bad change, in my opinion? I don't want to criticise the government or the revenue or anything, but 9 months, particularly for couples who are separating, which is a sad situation, but we do, you and I, we do the tax position of these couples. It takes more than 9 months to sort everything out. And to have just 9 months now as the CGT exempt period at the end when previously it was 36, very tough change.
Yeah, absolutely. I think there's a number of things, you know, there's other things we can't really cover today, the lettings exemption. There's a lot of changes in capital gains tax, the tax payments. So we can possibly come to us if you want some more advice, if you're thinking about, you've got an investment property, you've been living abroad, you come back to the UK, you can talk to us about it. If and particularly if you've used the lettings exemption. So if you've lived in a property as your principal private residence for a period of time, but moved out of it and then let it, you need to talk to us.
Yeah, very much so.
Another big change is this making tax digital. Now, most of you would have heard about making tax digital. So Tim, what is making tax digital and how is it going to affect the clients and their record keeping requirements?
Wow, it's a big change. There's two areas of making tax digital. There's making tax digital for VAT and making tax digital for income tax. Perhaps I can deal with making tax digital for VAT first. That's in now. And it's probably the biggest change on VAT for 20 years, for years and years. Very briefly, making tax digital for VAT comes in for the client who's VAT registered, who's got turnover more than 85,000, the VAT threshold, yearly turnover of more than 85. And it comes in for them for their first VAT quarter beginning on or after the 1st of April. So you and I had a client who early in the new year, they did their VAT return up to January. Old rules not affected. And then they do the next 3 months, February, March, April, old rules not affected. So it's the first VAT return that begins on or after the 1st of April. So for those guys, it'll be the 1st of May.
Yes.
And they do their VAT return under this new regime, VAT for making tax digital from the 1st of May, June, July. And the two things that effectively they've now got to do are they've got to keep all their records now digitally. The days of manual records are now finished for them.
No more brown paper bags.
No more shoe boxes, shall we say. That's not our firm, and I'll make that very, very clear. But you've now got to keep your records digitally. And the worst thing of all, really, they've blocked Gateway for these businesses. In the past, these businesses could tap into Gateway, put their VAT figures in, and everything was okay. Gateway's blocked now, and the client now has to keep all their records digitally, no more manual records, and they have to submit their VAT returns now using MTD approved software.
Yes. So I mean, the first thing I would say is that for clients, and obviously a lot of our clients obviously are not VAT registered, but the ones who are, the key thing I learned was not to leave your VAT return to the last minute because of the whole government gateway problems, because you may not be able to submit it. You may need to get a new gateway code, and that may take some time.
Indeed.
So it's certainly something that we're very aware of. So I think the number one issue here is do your first VAT return from now on as early as possible in the month in case you have any issues.
Yeah, I'd agree with that. And obviously, you've got to meet the conditions. You've got to be keeping your records now digitally, no more manual records. There's a fine for that. I mean, the fine for that, according to the legislation, is £500. So, you've got to keep your records now digitally, and you've got to use the approved software to send them in to HMRC digitally now. Gateway's blocked.
So is there going to be any concession? So if you miss the first quarter, would you still get the fine?
I doubt it. I think the revenue will be, HMRC will be understanding. I think they have to be understanding. We hope that they can be able to cope with all the changes as well. But it's a big issue, and I think clients now need our advice and help with it. I mean, there's a few things they could do, just very, very briefly. They could buy the software and do everything themselves, keep the records themselves, and submit the VAT returns themselves. But you and I have met a few clients recently, and they found that difficult. You know,
some of the smaller ones struggle.
So there's three alternatives really. The second one, they could come to us and we could do it all for them. We've got the software to do it, and we could do their VAT returns. Or the third alternative, I suppose the middle ground, is that they could keep their records on an Excel spreadsheet and then email us the spreadsheet every quarter, and we could use the bridging software that we've got to do their VAT returns.
I mean, in summary, what we're saying is that if you are worried about this, get in touch with us. We can do any option you want. We have a whole suite of options where we can do anything from just submitting the return for you down to your total bookkeeping system. So that's what we're offering for a lot of clients. Okay, thanks, Tim, on that. What I want to ask you, Tim, so now a bit more topical, a bit more interesting for some of our clients might be, so you want to reward your employees, but you want it to be in a tax and national insurance effective manner. So let's maybe give me some examples of things that we can do for our clients to help them reward their employees in the best possible way.
Okay, jolly good. Well, I hope you don't mind me reading from this, but one of our clients actually asked us that, and I prepared a list recently, which you're aware of. And I hope you don't mind, but I'm just going to read from this list because I think these are good benefits that the clients could do. So if the client's got a company and is thinking, or not always a company, a good organization, and they're thinking, what's the best ways that we could reward our staff tax-free, tax efficiently? Is that what you're referring to? And national insurance free? There's a list. And after this webinar, we could send you the list, but I'm just going to very briefly go through it now. There's 8 or 9 things that clients could do to reward their employees in a very tax efficient way, a national insurance efficient way. And I think the first one is that the client can buy a mobile phone and give the mobile phone to the employee and let them have the use of that phone. Okay. But even when they use it privately in the evenings and weekends, there's no tax. And I'm sure your family members rack up an awful lot of calls on the mobile phones. But this is an incredible benefit. But the key thing is the employer's got to buy the phone and give it to the employee, right? So no reimbursement here. The employer's got to buy that mobile phone, really, because they're doing it so the employee can use it for business. But in the evenings or weekends or at lunchtime, if they want to use that phone privately, they can do so. And all the private calls and everything, no tax at all.
So they can dispense with having their own mobile phones.
But the key thing is the employer's got to buy it. Second thing, there's a piece of legislation that says if an employer lends an item to an employee, such as a tablet or a motorbike or anything like that, if the private use is not significant, it's tax-free. So, I'm surprised this legislation exists, but it does. So people are taking advantage of it. The two that we've seen recently, one employer bought a computer and they let the employee use the computer mainly for work, and the private use was not significant. So that was tax-free. Another employer bought a tablet mainly for use by the employee for business. Private use, not significant, tax-free. So that's quite a useful one, really.
Yeah, absolutely.
The other benefits are on the health side of things. Now, I don't know if the viewers watching are aware, but there's something now called trivial benefits in kind. And an employer can provide a trivial benefit in kind to their staff up to £50. And if the employer provides this trivial benefit up to £50, and it's not in their contract, and it's a gesture, really, unexpected gesture, it's tax-free.
Okay, so that is a one-off £50, or is that £50 a month? Or
No. Well, basically, very good point. Basically, what you've got to do, if an employer thinks, well, I want to try and help the employees from time to time, reward them from time to time, occasionally they could give £50 trivial benefits to their staff tax-free. But the critical thing is it mustn't be in their contract of employment. It really must be to represent a personal event.
Right. Okay.
So a lot of employers do it at Christmas time, birthdays,
anniversaries,
yep,
Father's Day,
Father's Day, birth of a child. But trivial benefits can be used in so many different ways. For example, if the employee has got health problems or needs a flu jab or health screening, something like that, or eye tests, those sort of things would be under £50 and they'd be basically tax-free if you do them. So, you know, great opportunities here. The other thing that we've seen a lot of clients do is they provided Marks and Spencer's vouchers for their staff up to £50.
Yes.
But the one thing, or two things really, I think it's a very generous area by HMRC, don't you? By the government. But the two things are, first of all, if you were to give rugby tickets or football tickets to an employee and say this is a trivial benefit, the cost is under £50, the employer's got to pay for them and give them to the employee. They can't be reimbursement. Yeah. And the other thing is that...
so effectively, they must not be part of their employment.
No. Yeah. It's really like a one-off gesture, and they give it to the employee. The employer's got to pay for it and give it to the employee, no reimbursement. And the other thing is they can't give the trivial benefit to the employee, the £50 trivial benefit. It's tax-free, but they can't say to the employee, Johnny, you've done a brilliant piece of work. To thank you, here's the trivial benefit. So it can't be a reward for performance. Okay, so it's really got to be to recognise a personal event. Okay.
So just to, while you're going to, just to let you know, thanks for the questions. We've got some questions from you. We have seen the questions. We are going to address them. But we're just going to continue with this for a short while. And we may not cover all the 9 points, so you may need to come back to us for some points, but we'll cover a couple more because we've got quite a lot to get through. I'm conscious of the time. Okay. And there's some very important areas to cover. Okay. Thanks.
Okay, well, just finishing off the benefit side of things, because I think it's quite important. You really need to appreciate the benefits you can give to the staff that are tax-free, because it's a good way of rewarding staff. They're happy, and if they don't pay tax on it, it's a good thing. And some of the other ones, for example, would be if you provide a parking space at or near the place of work, that's tax-free. If the employer moves office to a different part of London, different part of the UK, and the employee has to relocate to move to keep up with them, you can pay £8,000 of their relocation expenses tax-free. You can also pay late night taxes when the employees work late. Amazingly, actually, you can pay up to 60 a year, 60, which is a lot, 60 taxes a year if they meet the conditions. And the surprising thing that we only discovered recently, when one of our clients asked on this business about the employees work late, can we pay for their late night taxes? I said, well, you can do it 60 times a year, which is more than one a week. Yes. So that's an awful lot. But the surprising thing is there's no upper limit on the cost of the late night taxi.
Yes.
And there's no limit on the distance between finishing work and the taxi home. So these are things, perhaps now I've mentioned it, that this will all be blocked up. But, you know.
Sure we'll have the Inland Revenue looking at this video at some stage.
Well, I hope not. But we've seen solicitors and stockbrokers, people like that, where the staff do work late, and they've constantly rewarded them with late night taxes, and it's all been tax-free. But as a firm, we can provide more advice on that after the webinar.
So before we go on to the next question, I'd just like to deal with one of the questions we've had. So the question we've been asked is, and I believe this is the question, is making tax digital relevant to landlords, to people who own property?
Yes, it is. It is. Making tax digital. What, on the VAT side or the income tax side?
I think what I would say here is obviously rental income is not going to be VAT. There's no VAT on it. So it doesn't come into force immediately. So if you're a landlord and you have a turnover in excess of 85,000, let's say, or even if you have any turnover, you're not going to need to make a making tax digital.
Well, it's just one consideration on that. Let's just look at the MTD for VAT side. I think the landlords that would have to worry about that would be a landlord who is renting out commercial property. I think that's what you were alluding to.
I think the question is probably
domestic. No, you don't have to worry about that.
Yeah, exactly. Commercial property is slightly complicated. We're not going to talk about that today. No. You'd have to make an option to tax, and that's a subject for another day.
Yeah.
But if you're a residential landlord,
no, you don't have to worry.
You do not have to worry. I think you discussed this with me, Tim, and you said to me that at the moment, I don't know if I can say too much, but we know that it's not coming in immediately.
Well,
and we'll leave it at that.
On the other side, making tax digital for income tax, which you're referring to now, they've delayed this, as you know. I think HMRC's aim would be, in an ideal world, they'd like to bring in making tax digital for income tax on the 6th of April 2021, in just under 2 years' time. But there's been nothing officially confirmed. As you know, it's been delayed. But when it does come in for income tax, this is going to be a major headache for the clients for income tax, because what the government is aiming is that clients affected with turnover more than 85,000, they'll have to do, or will have to do for them, quarterly accounts and put them on their digital tax accounts.
Was it not the case that they were going to introduce it if your turnover was more than 10,000?
Well, I think it's all been up in the air, but I think the latest position from what we've heard is that if the client has got turnover from their business of more than the VAT threshold, say 85, HMRC would expect them to do quarterly P&Ls, or we'd help the client to do that. But if their turnover is relatively small, they'll do 3-line accounts each quarter. But when this comes in, making tax digital for income tax, which has been delayed for a few years, every client will have a digital tax account, and the businesses will quarterly have to enter on the digital tax account their profit and loss accounts, and then eventually you'll have to do reconciliations and resolve it all. Massive issue, but thank goodness it's been delayed for a couple of years.
Maybe that's the one positive thing of Brexit, if I can mention it.
Yes,
we have to mention Brexit at some stage. Okay, lovely, thank you. Okay. So that's really making tax digital. Really, just a very quick introduction to it. Again, come to us, ask us questions, call us if you want some more information. The next thing I want to talk about is something called IR35, which we touched on earlier.
Yeah.
And in my introduction, I mentioned about this unfortunate lady, Lorraine Smith, who got a tax bill for £1.2 million on her doorstep. Yeah. So maybe you can talk to us about that, explain what that is, and what that tax bill was about, and did she actually pay it?
Right. Okay. IR35 is a very common term, and IR35 basically relates to the attack by HMRC on one-man band companies, Fred, trading through Fred Limited. And I've been in meetings with HMRC over the last few years on IR35, and I think really IR35, HMRC attack it in 2 stages. They find Fred working through a one-man band company, Fred Limited, and for HMRC to attack on IR35, the majority of his company's income, Fred's one-man band company, has got to come from one client. Right. In very general terms, as a rule of thumb. So IR35 is a revenue attack. IR35 is a slang term that originated from the 1999 budget. There was a press release called Inland Revenue Press Release 35. And everybody started adopting that as the code name for the attack on I-35. But it's an attack on one-man band companies. And how it works, HMRC find Fred trading through Fred Limited, and they look at his turnover, the company's turnover, and if there's one big client there constituting the majority of the turnover, vast amount of the turnover, in very general terms, HMRC will attack it under R35.
So if I can just stop you to Tim.
Yep.
So what we're talking about, so we have some specialist areas. So for example, if it was one of our doctors' clients, it could be a locum they're employing through a company.
Yep.
If we have a construction company, it could be a subcontractor or an IT contractor.
Yep.
It's such a vast area.
Very vast.
Or the media, as we've seen with the case that I talked about.
Yeah, very much so. So R35 applies to very big companies, very small companies. I've done consultancy work on it where we've defended TV personalities, where the income of their company is in excess of $1 million. We've done R35 cases on very small computer companies or building companies. But in a nutshell, to explain R35, is 2 stages. And HMRC have got to find Fred trading through his company, Fred Limited, and the majority of his company's turnover comes from 1 client. That's stage 1. And I've been in meetings with HMRC where they say, right, okay, we've established that you've set up your company, one-man band company, and most of your company's income, Fred Limited's income, comes from 1 client. That's stage 1. And then the second stage is HMRC will say, you only formed your company, Fred Limited, to avoid being an employee of the big client. And the revenue will say, if you didn't have your company, if you hadn't formed it, if you were still an individual Fred and you were working for this client, you'd be an employee of that client. Now that's the revenue attack, and they've got to prove that. So the revenue will say, we found you, Fred, working for a one-man band company, Fred Limited. Your company has got 1 big client. And the second thing the revenue say is, if you didn't have your company, if you hadn't incorporated, if you were working as an individual, Fred, for the client, we think the client will be employing you. And if the revenue can prove that, they win. It's a game of chess, really, but an expensive game of chess. For the client to win, the client's got to prove that if they didn't have their company, if Fred was working for that client, they'd be self-employed.
So the big case we've just seen a couple of months ago, the Lorraine case that I talked about. Tell me more about that. What happened in that case?
Well, with Lorraine Kelly, there's been a few on the personalities, but can I stress, as you know, this is for big clients, for small clients, little computer guys, construction guys, everyone. But on the Lorraine Kelly case, actually you mentioned her name, her real name's Lorraine Smith, but everybody knows her as Lorraine Kelly. She formed her company and she worked through the company, and her company had a big contract with ITV. And HMRC attacked it, and they said, Lorraine, if you didn't have your company, if you were just working directly for ITV, you'd be an employee of ITV. And she said, that's nonsense. She said, if I didn't have my company, if I, Lorraine, was working for ITV as an individual, I'd be self-employed. And in court, the judge said, prove it. And you have respect to Lorraine. She went to court and she said, if I didn't have my company, if I worked for ITV as an individual, I'd be a self-employed person. And she can prove that. There's no R35, no pay as you earn, no tax, no national insurance, under the R35 umbrella. And the judge said, prove it. And she said, I can. I'd be self-employed. When I go live on TV, she said, if I feel an interview is going very well, I allow it to overrun. So I'm in control of the whole situation. I choose the guests. She really runs that show. I think the biggest thing for anyone who's attacked on I-35 to succeed with is to prove that they'd be self-employed to defend the attack. I think there's a few things, but the most important thing is to prove that they're not controlled by that client. All right? And Lorraine proved that.
Also, the show had her name as well.
Yeah, it's a brand name. Lorraine's that brand name. And there was another case involving, you might know more about this than me, the lady who presents on Loose Women. Yeah. What was her name? Was it Kay Adams? Yes. Was it Kay Adams? I think it was. That was more I gather you watch that program more regularly than I do.
I saw it yesterday.
Did you? Oh, okay. Well, anyway, Kay Adams also won her R35 case, but that wasn't on Loose Women. I was up in Scotland last week and they were talking about it in Scotland, and she was presenting a radio show for the BBC in Scotland, and they attacked that engagement under R35, and she won, and she proved, a big case, she proved that if she hadn't got a company, she'd be a self-employed presenter on that radio show. She wrote the scripts of that show. She was controlling the program. there's no way that she'd be an employee at BBC Radio Scotland. She won very successfully. So do you know what? We can help clients with this. I think one of the big defences on R35 is you need a very good contract. Do you agree? Between the company and the engager? But the contract's got to tell the truth and represent the reality. And, you know, if you've got those things like there's minimal control over you, if anything, you control the whole situation. You can turn work down offered by the client. You can show there's no mutuality of obligations. That's a legal term, but you can prove that you can turn work down. If you've got a substitute, you pay your own insurance. So, I think with careful planning, R35 can be overcome.
We also know that there's another case which hasn't come yet. And we know that the Lorraine Kelly case, the Inland Revenue, they haven't appealed the case, which is interesting. You know, there's a lot of money at stake, 1.2 million pounds, we know. 900,000 tax, 300,000 national insurance was involved. And they haven't appealed the case. But we do know there's another, we can't talk about it today too much, but it's public knowledge, there's another well-known celebrity who's got another case coming up. Similar amounts, more possibly. So it'd be very interesting. It's a bit more money. So very interesting to see what the outcome of that case. We can discuss that next time. Maybe.
Just one thing on that. This is, I mean, we're at early May 2019. This is a very important time for R35 because if you were to take the last 9 cases that HMRC have had, they've only won 1 out of the 9. They're starting to lose them. And I think people, the R35 thing is beginning to switch. And I think personally, people are preparing more for R35, doing good contracts. But as you say, there are 2 very big cases and the verdict are due out on them anytime now. And I think if I was optimistic, I think taxpayers will win those cases. And I think that's a death knell for HMRC. And with careful planning, R35 can be overcome. But I'll say one more word on that. It's been in the public sector now for 2 years. So the NHS, when they engage companies, they're now responsible. And from 6th of April 2020, the R35 rules come over to the private sector. So
that's a massive change.
It is a massive change. And if the engager has got turnover of more than approximately 10 million, and they employ more than 50 people, they are a medium-sized engager. They're responsible for R35. And every time they engage computer companies now from 2020, they've got to consider, do we deduct pay-as-you-earn and class 1 from the fees? So big changes there. But I think accountants should be positive with it.
Yeah, no, it is positive. The case has been won. All I can say is that, you know, if you are a client and you're worried about that, either because you're either employing somebody who's a one-man band company or you are a one-man band company, you really need to talk to us. It can be the difference between you winning and losing the case, without a doubt.
Really important.
Just move on to the next area. There's been a lot of changes in the claiming of travel expenses. So this is particularly relevant because the case that we're going to talk about relates to a doctor. So it was traveling, but it does apply to everyone, of course. So tell me a bit more about how the changes have occurred in traveling expenses from home to your place of work.
Well, I mean, this is a big issue. We could do a long time on this, but let's just deal with one area. Self-employed clients, say doctors, dentists, people like that, they have to be very careful with their travel now because in recent years there's been a few cases, but I'd say the main case is Dr. Samadian. And I met his accountants, charming guys. I've had a good insight into that case. And I think with self-employed travel, not just doctors and dentists, but all sorts of people, if you, pick a doctor, or anyone really, you might have agreed with HMRC that your home is your business base. But if you're traveling regularly to a hospital, right, and you're working out of that hospital, you can't really claim that self-employed travel from the doctor's home to that hospital because the Samadian case proves that your business day starts when you reach that hospital, and that self-employed travel from home to the hospital will not be tax deductible.
So historically, we would have told our clients that if they were in several locations, the what we would call itinerant workers.
Yes.
The previous case of
Yeah.
the bricklayer who
Yeah.
worked in different sites every
Yeah.
day. So
Yeah.
we were quite relaxed. We would say
Yeah.
to a client, don't worry. If you're a doctor, for example, and you work at hospital on a Monday, every Monday at one hospital, and every other on a Tuesday you work at a different hospital, you are itinerant. So that's no longer the case?
No, it's no longer the case. I would say if you've got somebody who's self-employed and HMRC have agreed that you work from home, which they would do, and you could make a small claim for use of home as office and things like that. If you work from home, but every Monday you're a doctor, you're a surgeon, whatever, you work at the same hospital, that's your regular routine, that travel you cannot claim from home to that hospital. But itinerant workers can claim their self-employed travel in other cases. I'll give you an example. There was a case, I'm just trying to remember it now, it escapes me, but there was a case a few years ago where an electrician, Mr. Mellor, his name was Paul Mellor. If you Google that name, Paul Mellor, the tax case, Paul Mellor was a self-employed electrician, right? He was itinerant. The revenue had agreed that he worked from home. But every day he worked at a different place, different home, different, it was commercial, domestic, everything. And I saw one report that likened Paul Mellor to Paul Young. Do you remember Paul Young?
He used to live up the road to me. The
Did he really? Yes, the singer. Yeah. I was wondering if it was in your age group, Stuart, or not.
Yeah, a couple of years older.
Is he? Okay. Well, Paul Young was Princess Di's, you should mention Princess Di at the Royal Baby's time at this time of year. But Princess Di loved Paul Young. And what was Paul Young's biggest hit?
Shouldn't I? Don't.
Wherever I Lay My Hat. Okay. Do you remember that?
No, to be honest.
Well, you should do.
I'm a bit
anyway, Paul Young had this song, Wherever I Lay My Hat. And whenever I hear that coming on when I'm driving around on the radio, I think, I know I shouldn't think of tax, but I do. And I think you need to be Paul Young. You need to be itinerant, moving around, laying your hat. Wherever I lay my hat, move around, itinerant. Itinerant people like Paul Mellor, the tax case, he won with all his travel because he never knew where he was going to be from one day to another. But if you've got a set routine like Sir Madian had, and there was another case called Dr. Jones, that travel wasn't allowed.
Okay, so
you've got to review clients' travel now.
Got to be very careful. Yeah. So particularly any business. So obviously because he was a doctor, he was a surgeon.
Yeah.
Surgeons working self-employed, doctors.
But it's most professions, not just the medical profession.
And anyone who's working in different places needs to be very careful about your travel claims. You need to review your travel claims. Yeah. You need to look at your home office claims.
Yeah.
Okay. I'd like to perhaps talk to you about the entrepreneur's relief. So entrepreneur's relief is a very valuable relief. It's been extended. So can you tell me how's the client, would a client get entrepreneur's relief on the sale of not only their business, but for a lot of our clients, business assets?
Right, okay. Can I give you the background to entrepreneur's relief? Slightly amusing, I suppose, really. A couple of years ago, I actually met Alistair Darling, the previous Chancellor, and we were invited to meet him. He was giving a brief talk, and I met him in London. I was a bit upset, Stuart, that he didn't recognise me when I went to meet him, but that's another story. Anyway, I had a brief chat with him, and I said, Alistair, you were the Chancellor who brought in entrepreneur's relief. It was his baby, it was his decision. And I said to him, when you brought it in, what was your aim? And he said, my aim when he brought in entrepreneur's relief was anyone selling their business, I want them to pay 10% capital gains tax on the sale of their business and assets relating to that business, right? But you've got to be selling your business or part of the business. And so that was when he brought it in. He wanted people to pay genuinely selling their business a 10% CGT rate, capital gains tax 10%.
And that's unlimited?
Well, no, there's a limit, a lifetime limit of 10 million per individual. So there's anti-avoidance legislation as well. But what clients can do now is they can sell a business subject to any anti-avoidance legislation and pay tax on it at 10%. They can sell a few different businesses and there's a 10 million lifetime limit. So subject to the anti-avoidance legislation, you could sell your businesses and pay 10% CGT on the gains. But there's been some developments because our firm keeps up to date when we advise clients. And one of the developments is if you sell your business now from 6th of April 2019 onwards, you've got to have held the business for 2 years. Prior to 6th of April, it was 1. And Entrepreneurs Relief is in the news now because recently a case has been published called Richard Villa. And if anybody who's watching is interested in the background to CGT Entrepreneurs Relief, selling your business and get 10% tax, very minimal tax. You agree when you sell
Richard Villa, is that spelled like Aston Villa? Or?
It's spelled like Aston Villa. The team that, can I say, no, I'm not going to comment about Aston Villa, but the team that are in the championship at the moment. But anyway, it's Villa with an R. Okay. And this chap, Richard Villa, not Aston Villa. Villa, Villa with an added R, yeah. And Richard Villa, viewers should Google this case. It's, I think, the most important case there's ever been on Entrepreneurs Relief CGT. He sold his medical practice to the Spire Group for $1 million. And he filled in his tax return and claimed Entrepreneurs Relief, 10%.
And he left the business?
He sold the business to the Spire Group.
Yeah.
He had a loose contract where he was going to continue working for them, but nothing set in stone.
So he wasn't controlling that business.
No, he wasn't. Not really. Well, he sold the business. He'd taken a backward step. He wasn't running it anymore. He had other consultants. But it was a genuine sale of the business. And do you know what? When he sold that business, he got valuers in to value the patient list, to value the goodwill, to value the brand name of the business, the domain name. This was a genuine sale of the business. But HMRC turned around and said, we don't think that you've sold your business. Amazingly, they said, we think the $1 million represents an advance payment by the Spire Group for your future services. And if you were to have that, that would be chargeable to income tax. You were at 45% rather than the 10%. So a huge swing, but he won. And people should look at that case because genuinely he sold his business and sold the brand name.
So they gave him a tax bill of $450,000.
Well, the tax bill with the penalties and everything was 803.
803,000.
Yeah, 803
sold his business for $1 million.
Yeah, and because of the penalties and everything and the income tax, amazingly, I mean, this is incredible. On his tax return, he claimed Entrepreneurs Relief and he'd pay tax of 80,000.
Yeah.
But they demanded 803.
10 times the amount.
Unbelievable. With the penalties, you have to see the figures to appreciate it. He won. And I'll tell you what, if anybody who's watching this wants advice how to sell their business, the Richard Villa case is the best one. The judgment by the lady judge in that is really good. She makes it very clear. This is when somebody's selling their business, and this is somebody who's receiving an advance payment for their future services. So he won. But I tell you what, you and I have advised clients in the past on Entrepreneurs Relief, and you can do, particularly in the medical profession, a lot of planning. We haven't really got the time for that now. But I think clients who want more advice on that can come back and see us.
I think very important. Particularly if you're based in London with property. So if you have if you're in a partnership, you have a property, and you're retiring and you're thinking of selling that property, it can be huge amounts of capital gains tax at stake. So it's something you need to talk to us about.
Very much so.
I think we're pretty much out of time. We had some couple of other minor areas. I think if you've got any more questions, please email them to us and we'll deal with them. We're out of time to deal with any more questions, but thank you for your questions. And thank you everyone who's been with us for this here. I hope you've enjoyed it. I'd like to thank Tim for joining us. It's been an excellent session and some really interesting and fun cases we've talked about. I mean, hopefully there'll be some more cases over the next few months, and when we come back, we can talk a little bit more how those have developed, particularly our 35 cases. We're going to know the outcome of at least one more very, very big multi-million pound IR35 case. So we'll be able to tell you more about that. And I think if you want to email any more questions separately outside the webinar, you can email Emma, our practice director, at emma@rbpca.co.uk. And the final thing just to say to you is that this webinar is going to be on our website later this evening. So if you want to watch it again because it was that good, then please feel free to do that. Or if you know anyone else that wants to watch it, send them the link, and we'll be delighted for them to see it. So thank you very much, and goodbye from me.
Thank you.